This lesson covers the basics of chart patterns and formations. When identified correctly, these patterns often lead to a breakout. Our goal is to spot major price movements early so we can take advantage of them. Chart formations help us identify when the market is ready for a breakout and signal if the price will continue in its current trend or reverse, allowing us to develop effective trade strategies around these patterns. Double top and double bottom, head and shoulders and inverse, head and shoulders, rising and falling wedges, bullish and bearish rectangles, bearish and bullish pennants, triangles, symmetrical, ascending and descending. Let's start with double top. A double top forms when price reaches a peak it can't break, pulls back, and then returns to test the same level. If it bounces off again, this double top indicates that buying pressure is fading, suggesting a likely reversal after a strong upward move. For a double top, the entry order is placed below the neckline, expecting an uptrend reversal. Once the price breaks this neckline, a downward move typically follows. Double tops signal trend reversals, so they're best identified after a strong uptrend. The resulting drop is often about the same height as the double top formation. The price broke above the neckline and made a solid upward move, jumping nearly the same height as the double bottom formation. Like double tops, double bottoms signal a trend reversal. The double bottom is a trend reversal pattern, signaling an opportunity to go long after an extended downtrend. It forms when price creates two bottoms at a level it can't break. As shown in the chart, after a downtrend, two valleys appear, with the second unable to break significantly below the first, a sign that selling pressure is nearly exhausted, indicating an upcoming reversal. A head and shoulders pattern is also a trend reversal formation. The head and shoulders pattern is a trend reversal formation, consisting of a peak, shoulder, a higher peak, head, and another lower peak, shoulder. A neckline, drawn by connecting the lowest points of the two troughs, can slope up or down. A downward slope generally provides a more reliable reversal signal. In this example, the head and shoulders pattern is clear. The second peak, or head, is the highest point, while the two shoulders form lower peaks that do not surpass the head's height. For the head and shoulders formation, an entry order is placed below the neckline. The target price can be estimated by measuring the distance from the head to the neckline, as the price movement after breaking the neckline typically matches this distance. Once the price falls below the neckline, it usually moves at least this measured distance. The inverse head and shoulders pattern is a flipped head and shoulders formation, consisting of a valley, shoulder, a lower valley, head, and a higher valley, shoulder, usually after a prolonged downtrend. A long entry order is placed above the neckline. The target for the inverse head and shoulders pattern is calculated by measuring the distance between the head and the neckline, which indicates how far the price is likely to move after breaking the neckline. This pattern typically results in a notable upward movement following the breakout. A rising wedge forms when price consolidates between upward sloping support and resistance lines, with a steeper support slope indicating faster higher lows than higher highs. This pattern can break out either upward or downward. If it occurs after an uptrend, it usually signals a bearish reversal, while in a downtrend, it may indicate a continuation of the decline. In this example, a rising wedge formed at the end of an uptrend, with new highs occurring more slowly than higher lows. The price then broke downward, signaling a downtrend. Following the breakout, the price movement generally matches the height of the rising wedge. In this example of a rising wedge formation, it acts as a bearish continuation signal. The price initially came from a downtrend before consolidating with higher highs and higher lows. When the price broke downward, the downtrend continued, resulting in a notable decline matching the height of the wedge. So far, we've learned that a rising wedge formed after an uptrend typically leads to a reversal into a downtrend, while a rising wedge during a downtrend usually signals a continuation of the downtrend. In simple terms, a rising wedge is a bearish chart pattern that indicates an impending downtrend. The falling wedge can indicate a reversal or continuation. As a reversal, it forms at the bottom of a downtrend, signaling an upcoming uptrend. As a continuation, it appears during an uptrend, suggesting that the upward trend will persist. After breaking above the wedge, the price typically rises by an amount equal to the height of the formation. A falling wedge during an uptrend signals a likely trend resumption. After consolidating post-rally, the price broke above the upper trend line and climbed higher. An entry order above this line would capture the upward movement, targeting the height of the wedge formation. A rectangle is a chart pattern defined by parallel support and resistance levels, indicating consolidation and indecision. The price tests these levels several times before breaking out, trending in the direction of the breakout, either up or down. A bearish rectangle occurs when the price consolidates during a downtrend. When it breaks below the rectangle, it tends to decline further. A short order placed just below the support level would have been profitable, with the price moving down by an amount roughly equal to the rectangle's size. After an uptrend, the price consolidated before breaking above the top of the rectangle pattern, leading to a significant upward move. A long order placed above the resistance level would have resulted in a profitable trade. Similar to the bearish rectangle, once the price breaks out, it typically moves at least the size of the previous range. Similar to rectangles, pennants are continuation patterns formed after strong moves. After a significant price movement, buyers or sellers pause, leading to consolidation in a small symmetrical triangle called a pennant. This consolidation attracts more participants, resulting in a breakout from the pennant formation. A bearish pennant forms during a steep downtrend. Following a sharp price drop, some sellers close their positions while others join the trend, causing consolidation. Once enough sellers enter, the price breaks below the pennant and continues to decline, resuming the downward movement after the breakout. To trade a bearish pennant, we would place a short order at the bottom of the pennant and set a stop loss above it to exit quickly if the breakdown is a false signal. Unlike other patterns, pennants indicate stronger moves, with the height of the preceding move typically used to estimate the breakout's size. Bullish pennants indicate that bulls are likely to drive the price higher again. Following a sharp price increase, the brief consolidation allows bulls to gather momentum before resuming the upward trend. In this example, after the consolidation, the price made another strong move upward after the breakout. To trade a bullish pennant, place a long order above it and set a stop loss below to protect against false breakouts. The breakout size usually matches the height of the preceding mast. While pennants are small, they can signal significant price movements, so they shouldn't be underestimated. A symmetrical triangle occurs when the price's highs and lows converge, reflecting market consolidation with lower highs and higher lows. This indicates indecision, and as the slopes narrow, a breakout is likely. We can place entry orders above the lower highs and below the higher lows to take advantage of the impending breakout in either direction. This triangle pattern forms with a resistance level and higher lows, where buyers push prices up but can't break the resistance. As a breakout approaches, we place an entry order above the resistance and below the higher lows. After the breakout, the price usually drops about the same distance as the triangle's height. By setting a short order below the triangle's bottom, we could profit from the decline. In descending triangle patterns, lower highs form the upper line, and a strong support level forms the lower line, indicating sellers are gaining ground. If the support holds, the price may bounce and rise. Entry orders can be placed above the upper line and below the support. In this case, the price broke above the triangle and surged higher by roughly the same distance as the triangle's height. You might know what the chart patterns are, but do you know when to use them? Reversal patterns indicate a change in the current trend. If formed during an uptrend, they signal a potential downward shift, while those appearing in a downtrend suggest a possible upward movement. To trade reversal patterns, place an order beyond the neckline towards the new trend, targeting a distance equal to the formation's height. For a double bottom, set a long order at the neckline's top and use a stop loss in the formation's middle for risk management. Continuation chart patterns signal that the existing trend will continue after a brief pause. This includes wedges, rectangles, and pennants, which show buyers or sellers consolidating before moving in the same direction as the prior trend. Wedges can function as either reversal or continuation patterns, depending on the trend context. To trade continuation patterns, place an order above or below the formation, targeting at least the pattern's size for wedges and rectangles, or the height of the pennant's mast for pennants. Set stop-loss orders above or below the chart formation. Bilateral chart patterns indicate that price can move in either direction, making them trickier to trade. Triangle formations exemplify this, as they signal potential breakouts to either the upside or downside. To trade these patterns, place an order beyond the neckline in the trend direction, targeting a distance equal to the formation's height. For a double bottom, set a long order at the neckline and place a stop loss in the formation's middle. And that wraps up this chapter. We've gone over the essential concepts that will help you navigate the Forex market, providing you with a solid base to grow your trading knowledge. Thanks for joining me, and I'll see you in the next chapter.